Hey, I'm Richard Matthews. I run a wealth management firm in downtown Greenville and Fountain Inn, South Carolina. I've shot tons of videos on market trends, planning strategies, and financial education, and honestly, at this point, I've just talked too much. I'm bored of the sales pitches I hear in financial media, so now I'm interested in what other local financial experts are thinking about in the upstate South Carolina economy and markets on the No Nonsense Investor. Welcome to the No Nonsense Investor. We are here in Fountain Inn at Cucina 100, an awesome Italian restaurant on Main Street. And if you like Italian food and you're in Fountain Inn, you should be here. They have good drinks too, and people here work hard, super nice. You should definitely stop by. But today we have our guest, Jesse. Jesse Hansford is another investment advisor, and we're going to go through our normal questions and make sure that we wrap it up with a challenge question. So, you ready?
Absolutely, let's do it.
Awesome. So Jesse, I know you pretty well at this point, but let everybody else know who you are.
Wow. So I am a financial advisor like you. That's kind of how we connected. It's been a real pleasure getting to know you, and I know by nature of the fact that we do things independently, sometimes there's a lack of community in being able to bounce ideas, and so that's given us that opportunity, and that's how we've gotten to know one another. I am a managing partner, co-founder with my partner Chris Beard at Professional Planning and Wealth. We run money for folks in the upstate and beyond, so that's kind of my story.
Gotcha, good deal. So let's see, how long you've been doing this? How did you get here? What's your current business model? What do you like about it?
It's a great question. I've been in the Greenville area since 2007. Got started in the business at the same time, and so maybe I top-ticked the market as I got my acceptance letter for Edward Jones at the time on early October of 07.
Oh wow!
Right. So well, everyone can blame me for the great financial crisis, I guess. But it was a tremendous introduction to equity markets, right? And it's probably tilted my view on risk and everything else just because that's the introduction that I had. But started Professional Planning and Wealth 2 years ago, and it has been a wild ride, a fun ride, and an exciting thing both for ourselves and our clients.
Gotcha. Awesome. Yeah, I can relate to a lot of that. I mean, in my background, Ameriprise 05, so I was getting all excited up until that point. Oh my gosh, what have I got myself into? But awesome, and definitely, I've really enjoyed getting to know you over the past couple of years. It's hard to find people you can bounce ideas off of. We kind of, we care about the actual finance of what we're discussing with clients and how we're managing money, and it's not about selling stuff. It's not about products. It's not about the next client. It's about doing what we say we're going to do really, really well. And it's been a pleasure to get to know you and talk over the time here. But today, what we're going to talk about is the Secure Act, and specifically, I guess RMDs, right? Isn't that the gist of it?
You know, it had maybe one positive thing in that it delayed RMDs for a bit. But yeah, I know there are questions, particularly when it comes to inheritance of IRAs, that are a big deal. And so I thought, we'd have an opportunity to talk about that.
Yeah, definitely. I think just to give some context for people that may not be familiar with this, back at the end of 2019, if you can remember all the way back then, they passed the Secure Act, which stood for setting up community, no, how did that go? Setting every community up for retirement. I don't know. Whatever.
Yeah.
You gotta love how they do it.
That's right.
So in 2019 it was passed. It went into effect in January of 2020. We all remember what happened right after that. So everybody has forgotten about this thing. One thing it did was it moved the 70.5 RMD requirement to 72. That could be a good thing. It's another option. It gives people more flexibility, which we always like to have at our fingertips. But more importantly, for what matters, I think, the right here and right now, would be that these inherited IRAs used to be considered, you could get a stretch IRA, right? Wasn't that the term that we were brought in under?
Absolutely. The way it used to work, and you still have clients that are operating under this because, as you said, if mom or dad or a benefactor of money that we may have inherited died prior to January 1 of 2020, that advantage still exists, right? But if they died January 1st of 2020, then there has been a dramatic change in what the person, the beneficiary of that money, has to do in taking out those proceeds, right? That schedule now is 10 years, okay? And so you can imagine with varying levels of inheritance, if it's in an IRA, because those dollars that come out of the IRA are taxed as income, that can pose some challenges, right? Especially because the window of the distribution of that taxed as income has been shortened dramatically.
Right. So the way that we used to look at it is from now for the rest of your life, and there was a schedule that was, I think, tied into a census survey that was life expectancy, and so the portion that they would take each year might be 2%, and then it would grow over time, depending, right, on how much. But most of the time that somebody inherits a large IRA, they're kind of in the prime working years of their lives, which means they're in a pretty high tax bracket, relatively, right? And so if you start adding, let's just say 1/10 of the inheritance per year, there's not only a potential of paying more on the inheritance in tax, but more on your income as time goes on, and you know, God forbid you try to take it in one lump sum.
That's, you know, again, the lump sum thing is always something that is a scary proposition, and without knowledge as to what it is that's going to cost you, seek some help, right? I always, I can recall my dad telling me, hey, make sure your sister delays this if something happens to me, right? And it's not because she's an ignorant person, it's because the appeal of that coming, and maybe just a misunderstanding as why wouldn't I take it into my own accounts, right? But all that's to say, like you said, taking that all out at once is going to push you into a marginal tax bracket that's going to be very punitive to the value of that, and why the old system, as you stated, typically you just kind of drip it out as you were required, because then it continues to compound tax deferred, right? So this change, I think it's without debate, was a revenue producer for the government. Good, bad, or indifferent, okay? But as a citizen of this country, because I know most people don't like to pay taxes, right? Structuring that is a matter of importance, and knowing what you're doing is a matter of importance.
Yes, and we are discussing death and taxes combined, right? And if they can shorten the window of that inheritance, it boosts their net revenue, and that's the key. Is we want to, within the limits of the law, we want to reduce the revenue to the government and keep it in the family, keep it in the the legacy.
Absolutely.
So when we're talking about how to use strategies around this new 10-year window, what are the things that you're considering, and what are the things that you feel have the biggest impact?
So I've got a graphic, so if we'll put that up. The idea behind this graphic is just play with me here. The idea that someone has inherited $200,000 of IRA account, okay? And in years 1 and 2 after the passing, year 1 is the year of the passing, okay? Husband and wife inheritor have an income of $100,000. Mm-hmm. The next year they get a raise, they haven't taken anything, okay? So the yellow box in year 3, maybe one of the two spouses has retired, income goes down. There's some room now in that 12% marginal bracket, right? That allows for somebody to take some of those proceeds at an acceptable rate of tax, okay? You see that then play out through the remainder of the 10-year allowance, and then in year 10, after the compound of investment growth, ideally, you take the remainder out at whatever rate you have to.
It is what it is.
And now, granted, that is an example. Okay, that might not be your example. That might not be the example of a client that I just worked with that has a year of no income before more income, right? So it requires uniqueness and planning and just an approach that's unique to your household. But at the same time, it's an idea. It shares with somebody the idea that above that 22% bracket is a 24, and then it goes to 32, right? And so you can see how that cost starts to go up pretty dramatically depending on the inheritance, depending on your personal household income. those things are going to be important to consider.
Definitely. And I would argue that the 12% is the gift that the IRS gives us. The 12 to 22, it's first of all a very sizable bracket,
That's
but
right.
the penalty to exceed it is 22, a 10% increase in a tax rate. I mean, that's unreal. But if somebody's there, that's where they are. So, but also maybe think about a strategy where, you know, if we were to increase our tax deferred contributions to our own IRAs or 401ks and offset our AGIs as low as we can, even if we're not doing our Roth contributions like we want, it gives us a little bit more bandwidth to get the full inheritance in that IRA done within the 10 years. So year 10 maybe doesn't go that far into the 22% bracket.
That's right. No, it's a very solid point. Is like you said early on in this conversation, flexibility is a big deal for someone that has the knowledge in how to use those flexibilities to somebody's advantage. So good point.
Awesome, very good. So Secure Act, I hear there's some legislation that may be adjusting that or whatever. It's in talks through the House and Senate and so forth. So we'll keep you updated on how that goes. But I want to now transfer. I've been looking forward to this conversation. I want to talk about inflation and recession and what we're seeing in interest rates. We're in August, right? So we've gotten our CPI and our PPI prints and jobs and all these crazy things have happened in the market. It's all over the place. What do you think? What do you make of it? Open-ended question.
Wow. I've heard it said that, you know, if you claim to know what's going to happen next, you've not been around for any length of time, right? Because I think there was such a traumatic shift to normal economic models when they shut the economy down, okay?
Yes.
And so I don't think that all indicators are broken, but there are certainly some things that are acting out of whack right now. You know, I tend to believe, you know, neither are good things, right? Obviously, I think we can all agree to that. Inflation or recession,
Sure.
neither are good. I think it's fair to say that inflation is the preeminent problem that the Fed faces, and traditionally the Fed stymies inflation by use of ultimately a recession.
Yes.
Okay, so I don't want to root for a recession. I do want to root against inflation, and it seems we have to trade one for the other.
Certainly. Yeah, definitely. I think we're kind of in a tough position as far as how quickly to raise interest rates and how long to wait for the lagging indicator, right? In our discussions before, we're reading a lot of lagging indicators to try to project forward policy for not only interest rates, right? That's the one thing that if you move clients to cash, at least you're making some interest now on your money markets and short-term bonds. But if we're raising rates, we also have to consider the bonds, right? What is the balance sheet of the Fed going to cause in the bond market and the yield, right? Because now we've got a 10-year yield aiming at a federal funds rate. It just adds more pressure to the Fed, right? To navigate the soft landing, if you will, which I think it's only been done once. It was in the early 90s. And yeah, I'm not sure where we are, but as far as rising interest rates, what are some things that you're leaning to and away from when it comes to managing money?
So we find ourselves staying short on the yield curve, right? Because as you just said, yields have gone up in that space dramatically in the last 12 months, and so there is some compensation in that short end of the curve. Chris, my partner, likes to say, no need to go out in the big waves, right? Longer on the curve, where the volatility of an interest rate surprise might really hurt the capital, right? So that's predominantly what we're doing. You know, obviously there's still yield to be found in dividend-paying stocks for those that have the tolerance for that. But yeah, it's a challenging market, no doubt.
Yeah, I do like the front end of the yield curve. The back, though, there is this nagging in the back of my mind. Are we going to capture some of this? Because the rates are looking pretty decent.
They are.
And if we do mitigate some sort of an inflationary scenario, I'd like to lock in some long-term rates above our future. So anyway, yeah, you're right.
No, absolutely.
Nobody knows what's happening, but it's keeping us on our toes, that's for sure.
Yeah.
All right, challenge question before
Okay.
we wrap up here. Should you pay off your house when you retire?
I have strong opinions on that myself. You know, that is a question that comes up a lot, Richard, and I'm just glad you didn't ask something that I wasn't ready for. So thank you. No, that comes up a lot, and I assume it probably does come up a lot for you as well. So much of that, in my opinion, is tell me the cost of your money, right? The cost of borrowing, your mortgage rate, okay? Because so many of us locked in a much, much lower than historical norm interest rate, okay? So that's one factor. Cash flow obviously is a big factor, okay? And so I think between those two things, if I can expect to beat the cost of my money in an asset holding or investment, right? I'm going to strongly consider that, right? If the cost of the mortgage is going to pinch my cash flow, right? I've got to find a solution there, right? And so, you know, it's always going to be unique, but generally, the third factor that I've considered more recently is inflation. Okay, because if I've got a really good setup of a 3 or sub 3 cost of money, right? And inflation's expected to be 3 or plus 3, that cost of borrowing has actually mostly gone away over time. Because if I've got a $1,500 mortgage cost and I've locked that in for 30 years, 30 years from now, it's going to still be $1,500, right? And so why would I be in a hurry to pay that off, okay? Now, again, one of the things that we want to always acknowledge in our practice is, you know, we will share the numbers, right? But you have to decide what's right for you, okay? And I know there are families where no debt is just principle one, okay? Understood. I desire that myself, but in the current environment, I'm not in a big hurry.
I got you.
Because the cost of money is so inexpensive.
Nice. Yeah, so I've been across, most recently, the reason I'm asking that, I've come across a couple of cases. One of them, really, it's the source of the payoff that was the point that just made it a no-brainer. They were going to pull from an IRA or a 401k. And so if they were at I think it was 5.25%, so it was an old mortgage, right? And so we're at the tail end of it. So you look at the actual expense of interest on that each payment is going towards, and then you try to look at what the cost of money is. Negligible, like less than 1% on the actual amount going to interest. On the flip side, they were in the 22% tax bracket. So not only the opportunity cost of growth of, or even the inflation outlook, but they're going to take a 22% hit on this deferred money to pay off a negligible interest rate. So it's opportunity cost, right, is what we're discussing here. But you brought up a good point where it says it has to fit the cash flow, where a second scenario that came up, and it's probably embarrassing to admit publicly here, but I have actually recommended for a client who was retiring and they still had 10 years left on the mortgage to refinance to a 30-year mortgage. The house was not an important part of the estate, and their cash flow with their savings and their social was not enough to continue that payment. They would have either had to keep working, or eventually that payment would have been squeezed out by inflation, right? So we ended up refinancing, shrinking that payment to half of what it was, and it fit within their cash flow. And yeah, it's going to build equity slower, but it's being divided at the end anyway.
I don't think there's anything embarrassing about that. I did very much a similar thing with my mother-in-law, okay, because of a very similar situation. But that points to the uniqueness, right, of understanding the situation such that the tools in our tool shed can be used for somebody's benefit. And I know that's the practice that you run. We've talked a lot about our mutual desire to help the people that we serve, and I think that's ultimately what we're trying to do.
Well, that's all we got for this week at the No Nonsense Investor. I want to thank Jesse for stopping by. He's been great, good conversation. What we're trying to do is to actually provide value in real life for people right here, right now, in the upstate of South Carolina. There's a lot of things that affect us financially, and it's important that we talk about the concepts that work, the strategies with the experts, and not look to the salesman. We're going to be going around town, around the upstate here, doing these videos, and hope that you join us. We'll look forward to seeing you next time.